Hello, and welcome to another episode of Market Buzz. We are back with some interesting news today. We have what we like to call what we like to call a very packed day today with data. We have CPI in about 13 minutes. We just had JP Morgan earnings, which officially starts the earnings seasons in the stock market. The stock market's all over the place, was a little bit higher than expected. JP Morgan earnings spooked us a little bit because we thought they missed, but when you get into the details, you find out that it wasn't so bad. It was actually a pretty decent beat if you were to account that. So, welcome to another episode of Microbus. I'm here with Dimitris and myself, Nestor Mendoza. Make sure to check out our portfolios down below. Timothy and Mimi cannot be with us because this was like a spur of the moment thing, but make sure to check out their portfolios as well. But yeah, JP Morgan, scary, scary. For a little second there, I was like, I sold. I sold some of my position because just before the earnings, they were rallying. I think we were up 2% on the day. We touched the 330s, and then we came back down to 325. We're sitting at right now. JP
That's the,
Morgan.
that's the easiest trade of all time, right? Just
It's
buy.
been it's been so easy. Like it's been so easy to trade JP Morgan in the last couple of days. Like the volatility for a bank stocks been so high, but we've just seen like JP Morgan is going between 320 and 300, 320 and 300. Right now we're breaking above those levels, which usually after earnings they tend to like either stay flat or go a little bit lower because expectations always meet. There's nothing that breaks really the bank, and in this case I don't think it's any different. But yeah, I mean it's been such an easy trade. I mean, let me show you the chart. Right? I've just been buying. Whenever it's like 300 or lower, I buy. Obviously, like that works until it doesn't. So make sure to do your own research here. But it's been like a 10% gain in the last couple of like December. We're sitting at 315. We touched 300. That was a buying opportunity. Sold around 320. You bought at 312. It's like, and then it's like even before it was like we sitting 322. Bam, 300. It was like, whoa. So it just seemed to be like a very interesting opportunity.
Yeah, but this one is a very predictable bank to trade. Like, in your opinion, is it the best bank in the United States? Perhaps the world?
It's the most solid bank, I think, because they thrive in a recession, right? Whenever there's issues in regional banking, everybody goes to JP Morgan because they know that it's too big to fail,
Mm.
right? And they've always taken, I'm sure they've gone through so many different. Oh, give me a second. I have a couple of people speaking in my ear because the CFO of JP Morgan is speaking at the moment.
Okay.
Let me shut him up for a little bit.
Yeah,
Give me a
the JP Morgan healthcare event is in San Francisco as we speak. It's been going on for the last couple of days, and it's weird because it's like during the earnings they have something else. They are occupied with something else. But when I was waiting for the numbers to come out, and when I saw the numbers, I was like, what? The JPM just missed here, and then you look closer, and you realize, okay,
No, it's
uh,
just a little bit of financing wizardry that they did in order to move a couple of the numbers around. But then if you account, they actually did a massive beat. It was a $5.23. So this is actually a buying opportunity for JP Morgan if you've been looking to get in. We've just breaking. So like we are sitting at resistance and this likely breaks.
it wouldn't be a nice way to start earnings season
Not at
with
all.
one of the sure things missing.
Yeah, that's for sure.
Missed on top and bottom lines. It's not just one of the two.
Yeah.
It was like both.
Yeah.
Uh, so they're going to issue an Apple Card.
No, I believe that they're taking charge of it.
Okay.
So I'm not really, I have to double check on that, but it's like,
Yeah, the announcement was made last week. So this is something new.
yeah.
Uh,
But yeah, the CFO is commenting on the loss of Fed independence. What
mhm.
happens after that? So this is an interesting point based on yesterday's stream, which is just like tends to lead to steeper yield curves and damage to the economic dynamism.
Do you think the Fed independence is will be lost if Powell leaves?
No, but it'll be questioned. And the thing is all you have is trust, right? If you lose trust in the Federal Reserve, their power is gone.
Don't you think that okay, with the exception of Trump, that he can't wait to get him out of there and put his guy? Don't you think every single president that had the chance to select and appoint a Fed chair would appoint someone that agrees with his policies, whatever the political and economic agenda is?
Yeah.
So
But he's a dove, right?
it's like I'm the president and I'm appointing you as the Fed chair, and it's like you can do whatever you want. You can be independent, but I want you to be pro markets. I want you to be pro capitalism. I don't want you to be a communist. I don't want you to be a socialist and get you into there. So presidents appoint the one that they think can advance their agenda. Obviously, Trump thought differently when he appointed Powell. Like we said yesterday, Powell did a good job in his time as a Fed chair. So I don't think the Fed independence is going to disappear. I think
No, I don't think it disappears, right? But if you start creating questions on this, right, then it's like, okay, then who's printing our money, right? Is it right? Am I going to buy treasuries if this is the case, right? If the Fed is just able to print and they're just able to go crazy, go nuts, you start creating all of this uncertainty, and that could create inflation long term, right? Like if the Fed can't do anything in the short term, right, and all of a sudden you've lost that trust, the impacts are massive, right? Because it's like a lot of money could just leave the economy, right? And then we're talking about the dollarization, and then all of these different questions come into play. So that's the danger here, right? That's the danger.
I'm not really
Because at the end of the day, it's fiat. Like fiat currency is nothing more than the government's trust that it'll be sort of repaid on whatever value we give it, right? But there's nothing back in it other than the faith of the American government, you know?
I'm not really worried that the Fed independence will disappear.
I don't think it will. I don't think it will. Like, it will take a lot more. But when you start sort of, right, the thing is like, yeah, policy for Trump, that helps him right now. But what happens all of a sudden when you have massive inflation coming in, right? 10, 20, 30% inflation on a yearly basis. That starts breaking the bank, right? Like, people hate inflation, right? Because it's like...
Yeah, but that was never the case. Like 20, 30% inflation was never the case. Even in the 70s, when it was at the highest, it was like in the low teens, if I remember correctly, which is like a lot for the US. Is for some other countries is like a regular thing. That was like in the low teens, and that made them adjust policy quickly, getting in a new guy, increasing the rates by a lot, and that's solving the issue. But I think this is a storyline. This is something for the news to talk about. And I don't think the Fed independence is in danger in any way.
No, I don't think it is. I think it's a headline, right? Yeah. And it's like taking credibility of Powell, putting it in a new guy where he's able to like manipulate how the long arm end of the curve and how bankers start acting, how big players and bond players start acting. That will cause. That's what he's trying to do. I don't think he's trying to take away this is a way to take credibility from Powell and not take away credibility from the Fed. Right?
Do you know who would be the perfect Fed chair? Jamie Dimon.
It's okay. I like him at JP Morgan. He makes me enough money.
Yeah, me too. But at some point, it's been like 25 years in JP Morgan already. So in some point, he's going to want to retire, and that's
all right. Yeah. No, just to stop you there, because we have to do CPI overview.
All right, let's go.
You know, because we're about 4 minutes away. So headline expectation is expected at 2.7%. Headline CPI month on month is 0.3. Core is expected at 2.7 and 0.3. Now, if we get these numbers, extremely bullish for America, right? We just don't want any sort of misses, right? These are some of the expectations from the financial juice guys.
You don't want a miss on the upside, and you don't want a big miss on the downside either.
Correct.
Yeah.
Correct. Because then you start affecting sort of like debt markets and all these
Yeah.
different things, right?
Is
You
the
just don't
inflation?
want that uncertainty. Like
Is
short
the,
term, it could be beneficial for stocks, but long term, we could see some damage.
yeah.
But here, for example, because it tells you that the way that we are analyzing this is wrong, and it's more fear that comes from that than I think help. But yeah, we are like I'm expecting sort of in line or a little bit lower than expected. Commodities did sort of move to the downside during November, December. Obviously, there were some. There are some things that I'm scared of. The fact that the number came in such like so low, so much lower than expected last month because of all of the weird revisions the BLS had to do in order to get the number out, freaks me out. Because what if we,
If
right,
we
like
if we
if
get
we
the other,
see it this year, right? Because now it's month on month, like, right? So it's like, okay, so if you didn't increase it from November, but you're now increasing it in December, it's like, okay, like the old numbers are higher, like lower, right? So if the old numbers are lower, what's going to happen here? So the way that this could play out, it could go to that, to the upside. This was some of the things that HSBC is actually bringing up.
so you
So
think a possible revision to the upside, just to balance the
yeah,
yeah.
no, not even, but maybe just a couple of the numbers, the important numbers like rental, like the rental prices or homeowner rentals and all these different things could then all of a sudden spike up, and
Mm.
that could create a fears, right? So it's like we're coming off a lower than expected number, and then we're going into a real number. What are going to be the changes? Maybe Jerome Powell, maybe the FOMC disregards this because they know that there's weakness in the data, so maybe there's no effect, right? The question we just don't want is going back to a point where we're talking about hikes again, right? At all. Like that's the furthest thing we want. We either want to stay the same or we go lower, right? So that's what I'm sort of like leaning towards. I'm thinking again, we are within expectations. We're about a minute away, so I'll put in the thing and I'll call that out as I hear it.
We're
But yeah,
not just to clarify. I don't think we are anywhere near hikes, only because
correct.
we are way above neutral when it comes to federal funds rate. So
Yeah,
inflation has to reverse and keep going up for a couple of meetings, like 2, 3, 4, 5, 6 months, and then they might consider a hike. So the hike is out of the question at this point.
for
But
now. Yeah.
let me ask you one more question, and then we're gonna wait for the. What's your best case scenario, and what's the most ideal scenario for the headline?
A
Two
little
point.
bit of a miss. A little bit of a miss, or something along the lines of 2% inflation if this were all the months, right? So
No,
if we
I'm
were
talking about this month.
this month, January,
Yes.
the same. Like I want to get to 2%. 10 seconds. I want to get to 2%. So
All right. So go, and then I'm gonna
all right.
2.69 will be my, or 2.68.
In line with expectations, 2.7.
Mm-hmm.
In line. Market likes this.
Everything,
Everything in line.
even the month over month. Are the numbers cooked?
Hmm?
Are the numbers cooked?
Maybe. But this is in line with expectations. This is 0.3 expected.
Yeah.
Actually, core comes in a little bit lower than expected, which is ideal.
Yes. Yes.
Actually, yeah. Sorry, my bad. Core CPI comes in at 2.6%. The forecast was 2.7. So the core CPI is actually coming in better than expected. This is fantastic news for the markets. The market's going to digest this and going to love this. Now,
Okay. The futures are up. Crypto. Okay. Everything is in the green.
yeah, a market likes this. This is a lot of risk off the table. This is great news.
Let's fucking go.
Let's freaking go. Yeah, market likes this. Even JP Morgan might be up on this news. Yeah, no, JP Morgan flat, but Google's up. Yeah, the fact that core, it's like the headline comes in as expected, but the core comes in a little bit lower than expected. Like it's not enough for potentially putting in rate cuts, but maybe. I think it's just like I'm telling you that we might see rate cuts.
Rate cuts in January.
I thought, like, I'm in the camp that we might get rate cuts. Obviously, like, it's difficult because the market is expecting no cuts, right? I think we were sitting at less than 5%. So this is good. I mean, this is very, very good, you know? Obviously, we have to dig a little bit deeper, and we're going to do that as the year goes by, but
No, this is a good way to start the
the
day.
year.
Yeah, the
The
year.
day, the year, the week, whatever you want to call it. But yeah, this is fantastic
Earning
news.
season, everything. We want like the synergies to be like in order. We don't want the unexpected, but in line. That takes out, that removes the risk that we thought, you and I both, I think, thought that the numbers, they were like maybe a bit misleading last month. And they will correct this month, but that didn't happen. So, and December, it's seasonality, so that it can go either way.
Yeah.
Yeah.
But the fact that there was something very interesting in the jobs report that was, I think, hospitality was lower than expected. So what did that tell me? Right. And I could be freaking far fetching here. Like, this is just, well, that was my sort of thought
Yeah.
process when it happened. We did see some like a drop in the unemployment, and we expected that because of seasonality. But usually you would see that in temporary jobs, right? Because it's like, oh, we're seeing a surge during the Christmas holiday. We're going to hire those people. But the reality was we didn't get that surge in hospitality. We didn't in food services, all of these different things. So what that tells me is that, hey, like, we are seeing maybe we saw a little bit of employment, right, during December, that maybe cooled off the numbers because of what happened during November and before, which was like the firing and the readjustment of the number, which the Fed might actually analyze here. And the reason I think we get a cut is because I think the underlying numbers in the job data are actually bad, but they're sort of hidden by the way that they're analyzing those numbers. So if they take that into consideration, plus the idea that we're getting lower CPI in December when we should be actually getting an increase in pricing because everybody's buying, everybody's increasing and spending, even though prices do come down a bit, right? What could we see here, right? I think, like, the one thing I actually take into consideration is the price of Coke, right? So the price of Coke in December always drops, right? Like Coca-Cola. Right. I was like, this guy really talking. But Coca-Cola, right? Like, usually it's like $11 for 30 cans. I saw it for $30 for 30 cans, right? $7 for 30 cans, right? Because usually they give you that discount pricing they want you to buy other things within the store. So usually that brings people into the store, and then you see there is those increase in prices. Funny enough, we saw this year, but again, some of the data tells me that we should be seeing more, right? So it'll be interesting to see the earnings of Amazon ending 31st, right? Because we're going to see December. I want to see Walmart, Home Depot. I want to see big retailers just to see how they are starting to take this, right? Where are we seeing those decreases? Are we seeing it in the service sector? Are we seeing it on those drops on the service sector or on the pricing sector? And most of the things the Fed has always said that is like most of the inflation that we're seeing is coming in from the tariffs, the products, the things. But we are seeing deflationary effects on shelter. We're seeing deflationary effects on. And funny enough, shelter came in hotter than expected. I'm having a look at the data here. Give me 2 seconds. Let me just share this with you. This is super interesting because shelter actually ticked up, which accounts for a massive amount of
the CPI.
Yeah, and it actually ticked up. So everything else might have ticked down. New vehicles are down negative point. Whoa, that was a massive drop on new vehicle sales. Electricity. No, wait, where is it? Electricity services, 1% up. Utility. Oh, gas is up 4%. That's good for my trade. That's good for my trade. Even though, sorry for the people that have to pay higher gas prices, that sucks. You know. But make sure you follow Market Bus so you can take advantage of those price hikes. Yeah,
So the
energy and commodities drove this too. Funny enough.
so the
Well,
price of
this is the average. Wait, am I looking at the wrong data? Because it feels like I'm looking at table percentage CPI on all urban consumers. No, this is it. U.S. city average. Am I looking at the wrong data? I might be looking at the wrong data here. Nope. No, I'm looking at the right data. I'm looking at the right date, correct? January 13, 2026. Okay.
the thing about shelter and why Trump. So shelter, it's a big part of the CPI and how they calculate the CPI. And what we talked yesterday, Trump trying to ban institutions buying single-family homes, uh, getting Fannie and Freddie to do QE. He's doing everything he can to get mortgage rates down, to get interest rates
But
down.
that might backfire.
Yeah, but he's trying, and
Because
and
if you tell somebody they're not going to be able to buy something, and they've been let's say they were planning to buy it for the rest of 2026, they were planning to buy houses,
yeah.
and they're like, oh, by the end of 2026, you won't be able to buy any more houses. They're just going to go on a ramping spree.
Yeah, but we all know that interest rates are coming down. So this is not on a hiking cycle that you rush to buy before everything gets more expensive. It's actually the opposite.
In a cutting cycle, you mean?
No, in a hiking cycle, before they start hiking, everything's going to be more expensive in 6 months. In the next 12 months, it's going to be more expensive. You're going to rush and buy now. Now it's actually a bit the opposite. Like, I'm talking about interest rates, not the price of housing, but it's directly correlated because most people are going to borrow to buy the house. If you know that you can buy $1 million house for 1% lower in interest rates, if you wait a year, most people will wait a year. But during the hiking cycle, when the Fed is going to be hiking and perhaps they're going to do 3 or 4 rate hikes in the next year, you run to go get it now before it gets too expensive. And that's what Trump is trying to do. He's trying to get interest rates down because the US is a credit economy. In Europe, we buy things with cash. I mean, people borrow as well, but most people save the whole amount and they buy the house, or they owe very little. In the US, you put down the down payment, then you buy the house, you lease the car. So interest rates have a big effect to the American consumer. And Trump is trying to fix that. He's doing reforms. He's trying to ban institutional investors for buying single family homes. So he's trying. I mean, is it working? I mean, yeah, I mean, so far it works a little bit, but he needs the Fed to drop the rates. That's why he's trying to fire Jay Powell.
Okay.
Am I saying anything wrong?
No.
Do you disagree with me?
I think it's just like I think there is like a double-edged sword, right? Because the thing is, who benefits from low interest rates? Homeowners, because there's more buyers. So at the beginning, like if you can take advantage of it at the very beginning, where it's like prices have not moved and there's no buyers and you're the first one to have like the application approved and you can just get a mortgage for way cheaper, you're just going to buy whatever house on the market. But if everybody starts going, right, during COVID, what did we see? We ended up seeing housing prices massively up.
So 1% a year difference on your mortgage makes a huge difference.
Yeah.
1%. And for the average people, especially the low income, on the lower end of the consumer, they want to buy a house, but they're not going to be picky about it. If they can afford it, they're going to get it. The higher end, the middle and the higher classes, they're picky about where they're buying the house, if it's like a good school district and all that. They're not so much affected from the interest rates. They care, but not as much as a low-end consumer. So, and Trump, based on what I'm listening and his people talking, he wants the low-end consumer to do better. It's not for the high end. It's for the lower end. His constituents are like the lower end consumer. Inflation hurts the low end consumer, not the high end. The one with the less disposable income. What's going on with food?
No, I'm thinking. I'm thinking. I'm not reading this. I'm not reading.
Oh, okay.
Yeah. No, I'm thinking because it's like they get more access, because I was also writing down, this was an interesting note. It's like, what happens if all of a sudden Trump says, you know what, we're going to cap credit card interest rates? What are the effects?
Okay, so that's might be good. By the way, I don't think that's a good idea. I think
it's awful. I think it's an awful idea. Let the market decide.
Exactly. You should let the free market to decide how much they're going to charge. And perhaps the market has decided, and it's like 20% a year if you're not fully paying your bill at the end of the month. But yeah, he's trying. He's trying to do. He's
but
trying.
The thing is like, but then the thing is what you end up doing is actually the opposite of what he's trying. Like, right, like for example, I'm gonna try to explain it with the credit cards, right? So let's say, for example, you say, okay, we're gonna cap it at 10%, and he gets this, right? What does that happen? Like, what does that create? It creates people not being able to borrow money. Because it's like the banks don't want to take the risk, right? So maybe the lending standards just go way up drastically, right? So it's like, we're just gonna, like, unless you're making $1 million, we want to let you borrow 10K. So all of a sudden you're increasing their hurdle, right? And okay, you have already a credit card, maybe they can't take that away, so then that drops to 10%. Okay, the people that default are going to default anyways, right? And then you can't get enough income from other places, because this is not an arbitrary number. It's a number that makes sense to them. There's people that don't pay their credit cards, right? The first thing you stop paying whenever you're broke is your credit card, right? And then it's a way to create credit history in the States. So you're changing the dynamics of how this market is working. And it's just, at the end of the day, the banks are just going to be like, we're just not going to let people borrow. We're going to start closing credit cards because this is just not profitable for us. Right? And then how many people lose that opportunity? Right? And then all of a sudden it's like you wanted people not to pay much for interest rates, but the reality is that, hey, people can't borrow anyway, so why does it matter?
Yeah, the credit card thing, everything else he does, I kind of think it's a good idea. The credit card thing is like a bit off, because I don't think it's good to pay 20% interest rate. And the 20%, it's like compounded month over month over a year. If you pay the minimum that you can pay, that's when you pay the 20%, which is like the maximum. Not all people get that. Some people pay more than others. But yeah, the US economy runs on credit, and it's like exactly the same thing. If you tell someone that makes breads that you can only charge $2 for each bread, then I'm not gonna make.
What if the cost is $3, right?
No. Let's assume the cost is $1, and you sell at $3, and say, you know what? You should only sell at $2. Are you going to make more breads to satisfy the market, or are you just going to make enough?
The thing is like, for something like that, you're not going to get more demand because you're selling. Like, let's assume you're maxed out.
Yeah.
Right. You just lose a ton of profit, right? And you're redistributing income. Then we're going to communism.
And can he do that with an executive order? That's
you can, but then you're turning into Venezuela. I get my money out.
The legality is what I'm wondering.
No, it would be difficult. Like, I mean, like, you could do it in like extreme, but the thing is like, it's arbitrary, right? Because it's like the money, the value of money is based on everything else. It's not just on one product.
Yeah,
it's based on labor units. It's based on exchange. It's based on pricing. It's based on I can move this money the way that I want to move it. There's no restraints. There's no constraints. You're definitely going to take a lot of people out of the market because of that.
Yeah. However, following the announcement, we saw the big credit card companies, the American Express, the Visas, and the MasterCard. The stocks dropped, but not by 10%. It was like a 2-3%.
Because it's like it's
Which
America.
tells me that nobody
Market.
took it seriously, and whoever sold, it was just retail. It wasn't institutional.
Correct.
Yeah,
Yeah.
that was my take.
100%. Like this is just hearsay, right? Until you see something being either put forward in a bill or kind of like an executive order being signed.
Yeah.
And then you're talking about the legalities. Yeah, you could see maybe like a couple of hits, but then it's a buying opportunity because it's just like who's going to keep that? Like I don't think when was the last time we saw price fixing in America?
Like I don't even remember.
You know, like I've seen price fixing in Venezuela, and I can tell you what happened. Prices ends up like cost goes up, and then if you don't have the money in order to buy that, you're just going to stop making the stuff. So then what you end up doing is creating short-term maybe benefits for long-term massive cost, and then like a less productivity, like a massive drop in productivity because now you just don't have people actually making bread.
Yeah.
You know, it's like who will make bread? It's like the person that has to be like you either, you know, it's like, oh, what, you're going to make the bread maker continue to make bread, then you're slaving the bread maker. What's happening here, right? So it's like the bread maker makes bread because it's profitable, not because he likes bread. You know what I mean? Like he likes bread. Maybe that's how it started. But he continues to make bread, and the company continues to make bread because it's a profitable business. So
yeah, what is the quote from Adam Smith from the book The Wealth of Nations? That was a great book. I read it when I was in college. The butcher and the baker are not providing services because of their it's because of self-interest.
yeah,
So
yeah, greed is good.
Yeah, you want the individual to do what is best for him, and the good of one is the good of all. Yeah.
Yeah, he uses his skills and and time in order to make those things. Those like the rest of the economy makes it. You know, it's like right now I could be painting my house. I hired somebody to do that because I'm not a good painter. I'm gonna make more mess than actually. So it's like, yeah, I'd rather do what I do best, which is like pay attention to markets.
Trade the markets.
Yeah. Well, anything else? I mean, like we touched pretty much. This is. I think this is great news for the markets. I mean, we probably see a little bit of a selling off as traders sell into the open, because again, a couple mostly green. Be interesting to see what the Fed is. The markets are. Have a look. The Fed watch tool.
So what?
Fed what?
So what do you have left until the Fed meeting at the end of the month?
Well, we have PPI tomorrow, Producer Price Index.
Nobody gives a.
I'm telling you, the market's kind of doing. The market kind of pays attention a bit, but I don't think it's going to be a mover. No.
So when is the PCE? The PCE we did it already.
PCE is going to be just before. Yeah. Let me have a look. Just confirm this data. Let me have a look. So we have inflation data today. Then we have PPI tomorrow. We have retail sales tomorrow. So that would be important. Existing home sales also, just to see how the housing market is doing. Then nothing too crazy. Into next week, we are going into ADP. We're going into, no, that's just normal data. And then we have GDP growth quarter on quarter. And then we have PCE data on the 22nd.
Okay. And then on the
which
28th is...
we have the cut, the interest rate cuts. So unless we see something major in the PCE data, which I don't think we will based on the CPI data that we just got.
A PCE is the preferred metric for the Fed.
Correct.
Yeah. Okay, so I think
we don't get the cut, right? I really don't think we're going to get the cut unless something really breaks, or maybe Powell just gives Trump the cut to be like, okay, like we were very close to not giving a cut, but we are deciding to, so Trump leaves them alone.
No, the probe started already. I don't think he's going to go out of his way not to give a cut in January. Yeah, he's not bugging.
But it'll be interesting to see, because this is also something very interesting, which I'm gonna show you the cheat sheet. So let me go back to the presentation. We're going into Windows and we're going into here. right? This is something that I find so interesting, and it's actually like the Fed board, right? The majority of voters are, I think, the majority of voters are doves, right? So it's like Miron, super dovish. Then we have Waller, voting member, dovish. Bauman, dovish. Jefferson, dovish. Paulson, dovish. Cook, dovish. Powell, somewhat dovish.
Yeah.
Williams, dovish. And then you have Barr, neutral. Kashkari, neutral. Logan, hawkish. And then Hammock, hawkish.
Hmm.
The majority are dovish here, right? So it's like if my data is right, which I believe if you look deep in the unemployment, like this is the reason I think we might get a cut. I think that the market is mispricing the current balance. I think I think it's a 50-50. You know, and I think it's a 50-50 because that jobs data is not good. What happens if in like again, we have to take into consideration the seasonality.
The just the jobs data came out better this month than last month.
Correct, but it came in better because of technicalities.
It doesn't matter technically or not.
I know, but technicalities.
The headline, what's the headline? It's 4.6. No, it's 4.5. 4.5, 4.6 was like last month. So it's better than it was last month. And it's where the Fed expected it on the last FOMC. So we are in line.
But what if January is actually getting worse? Right? Like, what if January continues to play out and we're seeing the unemployment continue to deteriorate as people start firing people in January?
Yeah, but we're not going to know until the next CPI.
True, but they talk to their, like the Fed talks to their business people, right? So you can have
No,
this conversation.
They do, but they don't get any insights because we get. I mean, you and I were waiting for the numbers today. We got them like 5 minutes before the Fed. No, 5 minutes after the Fed.
But I think it's like, what if, right? Like, what if January starts getting worse and they're just like, because we still, like, I still believe that unemployment is the most important mandate right now. Inflation doesn't matter as much. They've already accounted for the fact that inflation is going to be coming down slowly. It's going to be the inflation fears, the tariff fears. That's it, right? And there's nothing inflationary in the economy that's going to cause major issues. So that's why I'm in the camp that we might get a cut. And the thing is just like we have to wait for Williams to speak because I know that he has a lot of sway in that board. What was the votes last time? What were the votes? I need to write that down, put that in there. But last time there were some people going to either side because we know Marin wants to really cut. He wants the 50 basis points. So it's like, what if he's starting to get in people's ear? I don't know. I'm in the camp that the market is mispricing this. I don't think it's a 50. Like, I don't think it's a 95.5. I really don't think so.
No, it's actually 97.3.
Yeah, but it's gone up. It's gone up. It's gone up a little bit. So it's 95.5 now. I'm telling you. But I think it's like a 60-40, more than a 95.
It was a 30-70 like 2 weeks ago.
Correct. And then the unemployment data came in better than expected. But again, the seasonality of it. There has to be the seasonality taken into consideration. If you look deeper, I'm telling you, if you look deeper, it's scary. It's scary what we saw.
I hear you, but I don't see it.
Yeah. No, the thing is like it's like for me, like the market. Sorry.
I'm not against it. Like, I'm not gonna be upset if they
cut one more. Like, I don't think one more is too much.
What?
I don't think one more is too much.
Yeah.
And I'm in the camp. Like, something tells me that the market is mispricing this based on just the way that I'm reading it. Like, the market believes is no cut. We believe there's no cut. But I'm just.
Would you rather not get one in January and just get one, start getting them in spring and then from spring we're going to the summer, and then
Just give me the cuts now. Stop messing about. Stop. If you need to cut if you need to cut already, so the market can start pricing this in.
yeah, but why to get them ahead of time when everything else works? Earnings go up. We are the market momentum is going higher. Why do you want to get them out of the way? Because once you get them out of the way, it's like
then we can focus on what matters: productivity. We can focus about
no, that's
the
not
rest
what
of
the
the stuff.
it's going to focus. It's going to focus on hikes. And when are we getting? Because once you get the cuts out of the way and we reach neutral, then the next thing is okay. So for how long? For how long are you going to be neutral?
I want to say neutral until something shows me that something is breaking, either to the upside or the downside. But right now, we're still sort of in this camp where the data is not trustworthy. It's coming in lower than expected. Trusted that it's going to continue to go up, and preemptively drop those interest rates, right? And then hold it for the rest of the year if you want, and just wait for data. Give me 3 months, 4 months. But it's like right now, you've just started it. Like you are in a cutting cycle. If you need to start the cutting cycle next month or in March, is it? That's going to freak me out. And if it doesn't cut because he's upset, and then all of a sudden the new Fed chair on June comes in and starts dumping interest rates, that's going to freak out the market more. So I don't want freakouts. I just want just continue to drop.
Okay, don't you think that
get me to neutral?
By not cutting, no, we're going to get to neutral eventually, but don't you think by not cutting and let the market digest the rates for a bit longer? And
because by the time you need to make the change, if it's lower, 0.25 is not going to make a difference, right? Like a 0.25 is not going to make a difference right now. So change that, because it's going to take a while for the long-term lending to come down. That's going to come down, right? Like you're just putting the short end, but the rest, you just come down a little bit more, secure it, just get it done. How much did we drop? It was 75 basis points last. Just drop a full point. Just drop the full point.
Okay, so doesn't matter if okay, let's say that in 2026 we're gonna get in total. Let's say if we knew the number is 75 basis points. Does it really matter when are you getting them?
Yeah, because the market takes forever to adapt. When the interest rates go up, everybody increases them, right? But when the interest rates come down, you can make the difference. So nobody cares, because it's like, if I know that my mortgage is going to be 6%, I'm not going to drop them until everybody else drops them. But on the upside, if all of a sudden the Fed is paying me 6%, I'm going to increase those interest rates. So I think coming down takes longer than going up. So the effects are more lagged.
So there's a difference between getting a rate cut in January and April instead of March and April. What's the difference?
Like a month is not going to be much difference, but it signals.
That's what I'm saying.
But the thing is like what you're signaling, if you don't cut right now, is that we're cutting and not cutting, not cutting and cutting, cutting and not cutting, right? You're going into we went into a cutting cycle and now we're stopping it. Oh, it turns out we needed to cut more. And it's like, the data was telling you this.
No, this is a new year.
But it doesn't matter.
No, it does matter.
The idea of the year, it's fiction. It's
not fiction. It's the same thing with the market. The S&P did 16% last year. Just because we roll them into a new year means we're going to have another 16%. No, this is a new reality. This is a new set. This is a new beginning.
Like for me, it's like we have that, but it's like that's man-made. You know what I mean? Like it's like that it's because we agree, but it doesn't, like, it's just another day and night. It's just another day.
I think the Fed works with that framework. This is a new year. We have a new way of doing it this year. Doesn't mean because we did the last cut in December, doesn't mean we have to do one in January. This is a new year, and we're going to do it because they're going to do between 3 and 4 rate cuts this year. And we know after May, whoever the Fed chair is going to be doing more cuts. So the question is, in the next 3 meetings, January, March, and April, in the next 3 meetings, are we going to get 1 or 2 rate cuts? That's the question that I have.
Let me have a look. Let me see what the market's pricing it. Let me just double check this data. So yeah, a week ago we were sitting at 17%. A month ago we were sitting at 24%, and that's just been like slowly climbing down. And I don't think it's warranted. But hey, so March. Let me know when you can read it good.
A bit more. There you go.
All right. So this is what the probabilities are, right? So we are saying that December we're going to stay the same. Then we have 27% chance of getting a cut, but we're saying the market's saying we're not getting a cut. And then in April we are evaluating, right? So it's like maybe we're getting a cut, maybe. But then we know for a fact that in June we're pricing in a cut, a 25 basis point cut. But the thing is like if Trump gets his guy in, we're not getting a 25 basis point cut.
You think so, or do you think we're gonna be getting a quarter point every meeting until we are like?
He wants to stimulate. The thing is like the only thing that's taking a benefit here, the only thing that's going up, and the only thing that's getting spending in the economy, we know this, it's AI. That is the problem. If this was a rally of everything and there was investing everywhere and this was fantastic for everybody, I would say, hey, we don't need to hike. Like, we don't need to cut. But the fact is that there are industries right now that are hurting. And the question is like, and small businesses and who, like the small players, is like, what happens to them? You know what I mean? It's like the small player gets hurt with high interest rates, even though they're not high. But I think it benefits them most if they're able to get liquidity out of there. If they're private businesses that are able to just like benefit from the moves, right? So that's what I'm in the camp of. I'm in the camp of that. Hey, just get us a little bit, like just potentially get us to stimulate. I agree with Trump. We should be stimulating a little bit more because the inflation fears are not. We had inflation because we printed like unprecedented amounts of money in order to fight massive unemployment and massive instability due to COVID. This is different. Like, you're not going to, like, just because you drop a 1% rate doesn't mean that you're going to get rampant inflation of 9 to 10%. You can't.
Yeah, because for a decade, we were like at zero rates and we didn't get inflation.
Yeah. So it's like, like we said it in this conversation, the American economy is based on debt. The more expensive this debt is, the more in danger you are. And we need to see the spending. We need to see the small. And the thing is like right now you don't have that rotation, right? Like you're seeing immigration is dropping in America. The best thing for America was immigration because it allowed the massive brains of every other country to join America. They've closed the borders.
Yeah, but that's not the people they're deporting. They're deporting the.
I know, but it still creates fears for people to go there, right?
Yeah.
If you ask the Europeans, they're like, yeah, no way I go to America right now. I don't want to get shot. It's like that's the narrative. You're
not getting shot, but yeah.
I know, but that's the narrative here. You know what I mean? Like you talk to people here, it's like, yeah, I'm not going to America. I don't want to get shot. It's like it doesn't happen. I've been to America. I know that that's not the norm, but you're creating this sort of like, oh, you have an insane man in power. He just makes whatever changes he wants. And it's like, we're saying by the end of 2026, we're going to be sitting at around 50 basis points of cuts.
No, that's just conservative. I think
it is.
I think we get 75, at least 75.
But give it to us now and allow for that pivot to happen, whether we have to stay neutral or go lower. Just a little bit. Get us to 3.25, 3% is kind of nice. I don't know. I'm in the camp that we might see it. I don't know. Like, again, last time it was that, right? Like, I think the market was sitting on a 30% no chance of a cut. And then all of a sudden we got the cut when Williams spoke, when Fed Williams spoke. So yeah, it was insane. So this is based. So this was for December. This was the December hike, right? The chances of getting a cut in December were sitting at around 19% at some point, and then we got the cut.
Oh yeah, you remember in November where I was expecting it, but most people weren't, and then we got it.
Yeah.
But again, this is a new year. This is a new reality. This is a new set of.
But it's not. It is the same companies, it is the same economies, it is the same industries. So like my rational brain is like, it doesn't, like, you know, it's like I get yours point. The thing is it makes sense. But something in my gut tells me that is like something is like shouting at me, and it's like, no, you need to cut, even though it's like it's a 1% cut. It's a statement. You know, maybe you were late because of the tariffs, right? I wonder if we didn't have the tariffs, where would we be at right now? They would have cut earlier. They would have cut earlier.
We perhaps will be at the end of the cutting cycle. And then at the end of the cutting cycle, what is it that you're thinking? You're thinking, okay, anytime now, we can start hiking, and then you can kiss tech goodbye. So why not delay that process? Why don't you enjoy another year of a
But you hike because something breaks. You hike because there's either
inflation,
price problems, inflation, price problems, and that's it. The only reason to hike is because there's price problems.
Nope. If you
What's the
remember,
other one?
in 2018, the Fed tried to hike at the end of the year just to be in a bit higher rates, just in case something happened, to be able to cut. And
but we are sitting nice.
The market collapsed in 2018. It was like in 20% in a month. So sometimes being a bit higher, giving you the optionality to cut if something goes wrong.
But we still have it. We're sitting at 3.5.
Inflation is not really a risk because it doesn't happen like a recession or like a bear market that happens every 3-4 years. Inflation, it's once in a generation kind of scenario, right? I think last time
like in America.
In America.
Yeah. And usually they're able to stop it.
Yeah, we're discussing the Fed, so we're discussing the American economy. It's not something that happens often. But yeah. Oh yeah, they stopped.
For the longest time, we couldn't even get to the 2% target. That's the reason we got to zero, because we couldn't get to 2%. We were trying to get to 2% for the longest time. So I don't know. I'm in the camp that we get a cut. I don't know why. Something is telling me that. I'm telling you, something is like, I don't know what it is. The chances are I'm wrong. The market tells me I'm wrong. Everybody tells me I'm wrong. And I'm okay with not. Like, if it happens, I'm okay. Like, I don't think that breaks the market. You know? I like the data that I read, based on what I read, based on the way that they're looking at the data, based on everything, tells me.
Okay. And I see your point, and I'm not going to be disappointed or upset or any of that if we get a cut in January. But if I was Jay Powell and I was deciding, even though we know he's not deciding by himself, it's like a committee, like the board. If I was deciding and I knew that we have to get between 75 and 100 basis points by the end of the year, I'm going to try to delay them. I mean, this is the best risk management you can do as a Fed, because you're going to give the market the rate cuts, but you want to give them as slowly as possible, holding the market, because as long as the market goes up, do you really need a rate cut? No, you need the rate cuts when the momentum stops. And if something at the same time, if something goes wrong, a recession, a black swan, you have a lot of room to drop rates and make a difference. But if you
you still have 3.5% to drop.
Yeah, but you're not going to. No, but the bottom is like the inflation rate. The neutral is the. Okay, some people calculate the neutral at the 2-year yield. I calculate the neutral on what's the inflation. So today the inflation is the neutral is 2.7, and we are how much? We are like
we're higher. So right now, based on that, we're restrictive. Why do we want to be restrictive in this economy?
You don't want to be restrictive, but you don't want to be more accommodative than you should be.
but you still have like almost 75 basis points that you can cut.
You realize that we're splitting hair now if we're gonna get
I
a
know, I
rate
know.
cut in January or March, right?
Yeah. Like the thing is like everything tells me,
Yeah,
like if I was doing the analysis, everything tells me that we shouldn't get a cut.
yeah,
If you, but if I after doing the research, which I have been keeping up with tabs on this,
yeah.
everything's telling me that it's like we are gonna get the cut. You know, so it's like
So what's the bet with Adrian?
no, like I put I placed a
50
bet in
bucks?
Polar Market. I put a place a bet. I put a place in Polar Market. I bet 50
Okay,
bucks,
okay,
right? So it's like I bet 50 bucks.
okay.
Now, if we get the cut, I make 800 bucks.
Really?
Yeah. And if we don't, and I think the odds are like 60-40. You know what I mean? So that's why I was like, 50 bucks is whatever, right? Like it's a meal outside.
Yeah, yeah,
So I was like, with my girlfriend, I was like, okay, like I'll put 50 bucks. Worst case scenario, I lose 50 bucks and I make a ton more in the markets.
yeah.
Because it's like I'm not expecting anything major to happen, and that's fine. Or I grab 50 bucks of my profits and I just make 800 bucks and I take my girlfriend on a really nice holiday. So it's like
Yeah.
a dinner for a holiday.
Yeah.
You know, and it was like, and I'm just thinking that it's more a 60-40 chance. Like I think something could happen right now, like layoffs or something that could spook the markets and then get everybody to say, hey, let's just focus back on, because we are still focused on the unemployment rate. But the Fed might as well be like, hey, the market is expecting no cuts, so let's just not get a cut. Let's not spook the markets. That's also something good. So I think that's a benefit, right? Like
Yeah.
as long as we get what we were expecting, markets will love it. We saw that today. You know, but then I will be profitable. But if we get the cut, I'm like 800 bucks. You know, it's like, so it was like it just feels like it's like I think the odds could be like 70-30 at worst case scenario, but I don't think this is this certain. I don't think it is because the data, the Fed has told you that they can't trust the data right now.
No, last month's data
We
I
need
can't trust.
no, this one also, because you have to compare it to last month. All of the numbers you're comparing to last month. So if you can't trust this month's data, you can't trust last month. It's driving me crazy. Okay, it's driving me crazy. I've been thinking about this for a while. But yeah, I'm in the camp that we're gonna get it. But I know that I'm so far away from the crowd in this one, and I understand why. And like, don't make any trading decisions based on this one. Like, I'm again, it's 50 bucks. So it's like, you know.
Yeah,
Well, everybody.
We're going to know in 2 weeks.
Exactly. Like, I think 2 weeks in this market is crazy. Like,
Yeah.
you imagine Trump calls Jerome and it's like, Jerome, listen, you and I both know that I'm the best president in the world. We just need 2.25, and I'll leave everybody alone. I'll leave Fred. What's the lady? I think Fred Williams is the lady. The late? No. What was her name?
What lady?
There was the lady that was getting. She was getting a ton of she was getting prosecuted for faking the mortgage application stuff.
Oh yeah, she was on the board.
Was it Cook? No. Who was it?
No, she's not letting that lady go. No, she will prosecute that lady.
Yeah.
Yeah.
But the thing was, like, some of the pressure came off. What was it? Yeah, Lisa Cook. So
Lisa
Fred Cook. Yeah.
That's you know what, you're right. That's when the pressure started.
Right.
Yeah.
Right. And they were like, no, like we just know, like obviously we're gonna let them do any research they want. And then all of a sudden we started getting talks of the cuts and the things and bam. Interesting. I was like, okay, like leave him alone. We're gonna start this. And then it's like, and the way that he spoke in one of the meetings was that, hey, you know, like if I'm Powell, and let's assume like I just don't want to deal with this, right? I don't want to deal with this, right? Like let's say it's what is 5% gonna do? The market's gonna but he's gonna, and then he's gonna be like Trump, like and then Powell, like Trump's gonna be like, oh, Powell did the right thing by cutting, even though he didn't cut enough, he cut, and that's the right decision, and like we shouldn't because he's a good man, blah blah blah, because he's gonna backtrack. He could backtrack 100%.
Yeah.
And then he gets the ending he wants for 0.25%, which is not going to make a difference in the grand scheme of things. You still have 3.5% points to cut.
Yeah.
Like the story, the narrative, something tells me. I'm feeling. I don't know. But I could be wrong. But okay. It's been an hour. Thanks so much, everybody, for watching. I don't think that many people tune in because CPI data is boring. But I enjoyed the conversation.
Yeah,
it was fantastic. Yeah. We're going to get a lot of clips from this. And then I'm calling it. If I'm wrong, it's okay. It's just another clip. But if I'm right, if I'm right with a 95% chance of getting it wrong, I'm gonna be on such a high horse. I'm gonna be on such a high horse. Oh my goodness. Oh, by the way, I have an episode with Bona Casino today.
In Spanish?
Yeah.
Okay.
Yeah. It's gonna be interesting. I'm talking about Venezuelan oil.
Are you guys gonna have what was the conversation about? The Venezuela story?
No, so we're gonna talk about a couple of things. So their episodes, they started a YouTube channel. By the way, I'll link it down below. But yeah, they started a YouTube channel and they just have conversations about the markets, about companies, what they're doing. It's Spanish speaking, guys. So eToro is Spanish speaking, And so far they've been doing good. So I think it's gonna be me and Catalina today. It's gonna be fun. Okay. Yeah, it's just a couple of conversations. Just talk about markets the way that we see them. Yeah. Talk about specific companies, see what we see from there, and then throw questions, and it's just debate, just conversation, which I'm super excited about. I'll let you know how it goes.
Good.
All right. Thanks everybody for watching. We will see you in the next episode on Thursday, our regular hours. We have earnings coming up, banking tomorrow with Bank of America and Wells Fargo. JP Morgan did fine today. That was a great piece of fresh air. The economy is still not collapsing. Markets are loving the CPI data. Core CPI came in lower than expected, and this was fantastic. Thanks so much for watching, everybody, and peace.
Bye everyone.